Hi guys, welcome to accounting. Today we're going to start a new chapter. We're now into chapter 3, and it is starting the accounting cycle for a service business. So in chapter 2, let's just review a little bit. You learned about double entry accounting, which remember every transaction that you have has at least two accounts. You have a debit and a credit. And your debits and your credits must equal, at least in monetary amount. Now, you may have two debits and one credit, or two credits and one debit, but as long as the total number of the money amount of debits equals the total money amount of credits, that's what you need to do. And also, you learned about preparing a trial balance. The reason for a trial balance is it helps you to check the equality of debits and credits in your ledger. So now remember, it doesn't mean that you have put them in the right accounts. It's just that your debits and your credits are equal. Now let's review a little bit from chapter 2. We have talked about this before, but I thought it would be good to review before we go on to chapter 3. Remember, total debits always equal total credits. And we learned about T accounts. Here's your T account. Remember, the left side of the T account is a debit. The right side of the T account is a credit. Doesn't matter what kind of an account it is. A debit means left and a credit means right. Okay? Now you have assets. Remember, assets increase on the debit side and decrease on the credit side, and they have a normal debit balance. Liabilities, on the other hand, increase on the credit side, and they decrease on the debit side, and they have a normal credit balance. Same thing with the owner's capital account. It has a normal credit balance. So that's the side where it increases, and the debit side is the side where it decreases. Now, your temporary owner's equity accounts that we talked about, you have the revenue account, and your revenue account has a normal credit balance, and to increase it, you credit, to decrease it, you debit. On the other hand, your expense account has a normal debit balance, so to increase it, you debit, to decrease it, you credit. And the same thing with the drawing account. Has a normal debit balance, so to increase it, you debit, and to decrease it, you credit. Okay, so now in chapter 3, we reviewed our double entry accounting. Also in chapter 2, you learned that the objective of double entry accounting is to make equal and accurate debit and credit entries in the proper accounts. And you were using T accounts. Well, recording business transactions in T accounts accomplishes this. But recording transactions in T accounts breaks up the debit and credit parts of an entry, since the debit is recorded in one account and the credit is recorded in another. That's fine, but the likelihood of errors is greater when the debit and credit parts of an entry are recorded on separate pages of the ledger. So to overcome this problem, we are going to learn something new today. We're going to learn that the first formal record of business transactions is made in a form known as a general journal. It's also known as the Book of Original Entry. So today what we're going to do is we're going to look at a general journal page. So here is the general journal page. And you notice we're going to use this instead of a T account. And like I said, this is the Book of Original Entry. And it is a two-column journal, and we're going to look at the parts of it. The first of it is, you notice you've got a page number here. So when you have more than one page of a general journal, and you will, you're going to be numbering the pages to keep them in order. Also, you noticed in the T accounts, you had them like ABC transactions. They were identified by letters. Well, now you have a date column. So we're going to be identifying the transactions by date instead of assigning them an alphabetic character. Also, you have account title. So this is the T account. In case, for example, if you were debiting cash, you would just list cash here. Posting reference is later on, so you don't have to worry about this column now. Just leave it blank. And then you notice you have a debit column and you have a credit column. So anything that you were going to enter on the left side of the T account or the debit side, you enter it in the debit column of the general ledger. And conversely, anything of credit, you're going to enter it in the credit column. So let's take a look at a comparison. For example, this was a T account problem that you did earlier. And you see, here's transaction A, and you have the debit is in cash, the credit is in capital. Well, let's look at the general journal. Let me see. You see here, you have a date. Now, what I did was, instead of A, B, C, D, and E, I said November 1st was A, the 2nd was B, the 3rd was C, the 4th was D, and the 5th was transaction E, just to keep them separate. But let's compare the two. For example, on November the 1st, you list the month and the day here. This little column here is the year. So 2020, I just put 20 there. And then when you list things in the general journal, you list the debit first. So we have a debit to cash of $8,000, and then we had a credit to capital. And you see how they're in two different places. Here, they're all in the same place. They're in a general journal. The debit is always listed first. So cash was our debit, and we put it in the debit column. So we debited $8,000. Our credit was Greg Calloway Capital, and notice I indented a little bit here. That's just so to make it easier when you look at a page that you can find the credits and the debits. So I indented the credit, and then I made a credit into the credit column. I credited capital. And you see, you list the debit first, you list the credit second, and then you indent a little more and you put the description, which is so much easier because, remember with the T account, you don't have a description. So in this, you do. In the general journal, you do. So cash was a debit, capital was the credit, and then your description. And notice we've indented each time just to make it easier to read. Now the second one was, let's find it here. We debited equipment and we credited accounts payable. So we purchased equipment on account. So we would debit equipment. Notice we list equipment first because the debit comes first, and it is against the left margin, $1,200. Then we credited accounts payable. Notice we indented a little bit. Credited $1,200. And then here's our transaction description, purchased equipment on account. So everything is there together on 3 lines. All right, and then November the 3rd, office supplies. We debited office supplies. We credited cash. See, here it is in the T account. So we credited cash and we purchased office supplies for cash. But you see how much easier a general journal is to use and to read than a T account, because you have both entries together, and you also have the transaction description. So that's what you're going to be doing in Chapter 3. And these are the transactions that we used. Greg Calloway invested $8,000 in a new business to be called Callaway Electronics. Purchased equipment on account, $1,200. Purchased office supplies for cash, $500. Purchased shop supplies on account, $300. And we paid $600 on the equipment purchased in transaction B. And again, what I did here, this was what we had used before as an example. I just took the letters and I converted them to dates. I just assigned a date of November 1st, 2nd, 3rd, 4th, and 5th. So again, to review and to look over this, I've gone to the full sheet of the General Journal. The date, account title, debit, and credit. And remember, if we debited in the T account, it's going to be a debit in the General Journal. We talked about cash. The owner invested in business, so we debited cash. We credited capital. The next transaction, we purchased equipment on account, so we debited equipment. We credited accounts payable because we bought it on account and we will pay for it later. The next one, purchased office supplies for cash, and we debited office supplies and credited cash. Now remember, each of these, cash is an asset and we're increasing it, so we debit it. Equipment is an asset and we were increasing it, so we debit it. And office supplies is an asset, so we increased it and we're debiting it. The next one is shop supplies. We purchased shop supplies on account. So we are increasing shop supplies. We're debiting it because it's an asset, and we're crediting accounts payable because we're increasing accounts payable because we purchased something on account. We didn't purchase it with cash. We put it on credit and we're paying for it later. So we see we've credited it $300. And then finally, the last transaction in our example, we paid on the equipment purchased in November the 2nd. So we debit accounts payable because we are reducing it. It's normally a credit balance, and to reduce it, I need to debit it. So I'm going to list my debit first. We paid $600, and then we're crediting cash because we're reducing cash because we're paying on our debt. Notice we paid on equipment purchased $11,200. Notice we're reducing accounts payable. We're not increasing equipment. We're not buying more equipment. We're reducing the debt. So that's why we debit accounts payable. So just to review very briefly, when you prepare your General Journal, you're going to list the date of the transaction. You're going to list all the debit and the credit parts. You're going to put the debit first, indent a little bit, and put the credit, and then indent a little more and put the description, because that makes it easier to read. If you look down through here, you see how much easier it is to read. We know what is credit and what is debit, and we can see the transaction description. And also the posting reference. We are leaving that blank because you don't need it now, so don't use that column. And anything that is a debit, you enter into the debit column, and anything that is a credit, you enter it into the credit column. And your debits and credits equal, just like a T account.